Great. Welcome, everybody. We're going to give it a minute to let you all trickle in, which we're seeing here. We come to you from respective parts of the world. I'm here in Miami, and Carver, you're in freezing cold Canada in Edmonton.
I'm in Edmonton, Alberta, and the couple of folks that are rolling in here, Ed and Clement are both, Rebecca are in Edmonton here as well. We've definitely got some local Edmonton folks that are hopefully having a snow day today at home. It's like I was mentioning, Jody, a natural blizzard here today.
Well, I'm old enough that I grew up in Buffalo with the blizzard of 77, where, literally we had to dig our way out of the front door.
Yeah, yeah, we're not quite there yet here, but by the end of today, we're supposed to have 2 feet of snow. So we're working
At
on it.
least you're used to it and you have infrastructure.
Yeah, it never gets old though.
Yeah.
Every year.
Great. Well, why don't we get started? I know people are trickling in, and I'll just give an introduction. And it sounds like you know the folks on, but I'm J.Thelander, founder and CEO of J.Thelander Consulting, and we are a compensation, data, and consulting firm, and we cover the global private capital markets. So that includes compensation, data, and consulting for private companies globally, as well as for the very investment firms as well. And Carver, how about you? Just in case there's someone who doesn't have the luxury of being in your team.
Yeah, awesome. Yeah, I got some familiar faces in the room here. So it'll be a bit of a recap for the folks here. So I'm Carver. I run a company in Edmonton up here in Canada called Solus. And what it is we're a fractional executive platform. So we work with companies that are generally between 3 to 100 million in revenue, and we'll help resource them with executive talent, but on a part-time or fractional basis.
Great. Well, we have a small group. We're going to have a small group even as more people trickle in. And we've got Morgan on my team who's monitoring. So, given the fact that it's a nice chance to have it be interactive, please feel free to ask questions and ask, happy to slow down or go to our platform. I'm going to start with a little bit of data because I think it's always easy to couch the conversation. So, basically, we're looking at private company compensation. I gave you a little bit of background about us, 30 years of doing this, and lots of lengthy discussions with the press. I just had an interview yesterday with the Wall Street Journal. So it's good because they help keep us really strategic in the way that we're looking, because the data is also needs to be couched with analysis. And then also it makes us really reflect on what's going on. So a lot of interest now in the private markets, and private companies are sort of the industry standard for how maybe public companies might be streamlining. We have a great podcast. My daughter and I, Morgan, have a Caplander podcast for all things private capital markets. And we've had a nice mix of VCs and company CEOs and the whole gamut. So we hope you tune in and listen to that or watch it. So we like to look at data. Industry really does matter. And Carver, you'll weigh in on this too in terms of the search, the part-time folks. We see a difference in whether a company is a biotech company, a device company, or a tech, which can be a lot of different things. We also see a lot of difference in company depending on the total financing that they've raised to date, which is really the best way to look at compensation. And maybe you can let us know how that impacts when you're doing these fractional people. Like, at what stages are you seeing it valuable to have fractional people versus then they hire somebody, or what's that trajectory like?
Yeah, for sure. So that's kind of, the base point that we would work off is that 2 to 3 million in revenue. So it's revenue and profitability to be able to support, hiring out an executive team and adding to the current team. All the way up to, $100 million in revenue, and sometimes over, if companies are trying to build out a division and they still, they want to test the waters, they want to bring somebody in on a contract basis, have it be flexible so that they can get in and out of the engagements.
It's so funny you say revenue, because I'm going to go back here to this slide. We so much you can see that from the data from here, right? The medical device and biotech is 66%, and in those companies there you never see revenue, right? So we always look at data by total financing, and you also can see that this 200 million plus, we used to just go 70 to 90 and 90 million plus, and now we're up to 200 million plus. And this always comes up in discussion because the private companies are staying private longer. Although I was just listening to the a Wall Street Journal podcast this morning, and they're saying that 2026 is looking like it's going to be a frothier year for IPOs. There's several, and once that starts rolling, hopefully more will as well. But revenue is a way to look at data, but I still would argue that when you're looking at the cash equity mix, that the equity should be looked at based on the total financing, even if you factor revenue in. And that's better than most recent series of financing because in today's world, it's taking so much longer and the rounds can be more impactful and more dilutive. Our data here, you can see primary location about 90% almost in the United States, and we're growing. And within the United States, Northern California is a big part, but companies all over. And then globally, you can see Canada. Canada is about 1.6%, Europe, which includes the UK. So we do cover really global data. And then within Europe, job titles. I mean, Carver, you know this better than anybody. We have added more titles. We can't keep up with the titles. And we go all the way from the chief titles down to the director, engineering, all these different levels. And I think to put in a little sales pitch, if you ever want to try the J.Thelander data, which of course we would love you to do, it is a give to get model, meaning participation is free. When you participate, you get access to the exact titles that you give. So if you have a CFO and you give that job, or you have a fractional CFO and you want to know what it would cost, then you get that data on our platform. Morgan just put in the survey link here. So it's sort of a no-brainer because you gotta calculate and look at the compensation. But Carver, what are you seeing in the market for fractional roles? What are the biggest ones?
Yeah, so CFOs have always been popular since the early 2000s, and that
Yeah.
still holds true. Um, Fractional CHROs or VP People and Culture are also very popular. I think as companies are scaling, again, and we can refer to it as not only revenue but funded through venture capital dollars or private equity as well. We do look at that. But as those companies are scaling, finance and human resources are two of the most glaring things that are in owner operator spaces. They start to have to deal with the bank. There's no new debt financing. Maybe there's equity
Right, so they
financing that
need
comes
someone
into play.
sophisticated, but they may not need them full time.
That's exactly it.
Yeah, and it's a perfect way to segue into this area. So when we look at comp data and also the fractional world, on the private company side, there are a couple of different comp levers. So one is the cash side, which is base salary, we track, and then current bonus, which means it was paid, so it's an actual number. Target bonus, which means it's out on the horizon for the next year. And we look at all these numbers as both as a dollar amount as well as a percentage of base pay. And that gets you to total cash. So total cash could just be base salary, or it could be a combination of base and a bonus that was given. And what are those comp levers used for a fractional person? Are they just salaried? Is there a bonus, or how does that work?
So we'll generally work off of an hourly rate that we can build into a retainer. But we're very outcome and deliverable focused. So we're always trying to figure out why does the company need the resource? What problem is it that they're trying to solve from the gap that they have on their current team? And how do we fit into that gap and solve it within the budget that the company has? And so those
Yeah.
hourly rates that we'll see in Canada are generally between 150 to 250 roughly per
So
hour.
you break it down, you back into it from what the salary would be.
Yeah,
Yeah,
exactly. So if we looked at
totally.
a full-time salary, it's literally a chunk per fraction.
Yeah, I couldn't agree more. I think that's the right way. And also, well, let's look again at this other component, obviously the factor. So, as we discussed earlier, you're not typically giving those fractional people equity. And that's obviously the golden egg for the private company. So, equity comes in a number of different forms. One is for a founder who gets their founder shares. But that's a one and done. If a founder gets their founder shares, they don't get additional founder shares. They can get an additional equity grant for their current job, which is our second, bucket here, and we track that because it's really important. And obviously, if the founder gets the right amount of equity, which is really high in the beginning, and they raise capital and it gets diluted down, then they're in a good position. If they didn't get the right amount of equity in the beginning and they didn't give themselves enough, for example, then that bucket of founder shares for their current job needs to be a little more substantial. And the total number is what's very relevant. And then that is separate and apart from a non-founder who is the executive or the individual on the team who is hired just from outside. So let's look. I like to look at data in a more custom way, but the Canada is, you saw is a smaller percentage, which is why we're doing initiatives like this so that we can have more survey participation because And that's why we give the data away for free because it's all meant for the greater good. So this is in US dollars, and this is median 75th for max. And this is what we're talking about for CEO was the base pay. And the actual bonus is the dollar amount that was paid out. It's crazy. It went from the medium at 14,500 all the way at 150, 160. I don't know, maybe that is missing a zero. Morgan, you're on. Maybe you can check that number and see if that's what's going on here. And then it probably would be right. My guess is the median should have been $145,000. And then the total cash, though, the part that's really important to see here is that the total cash is not an addition of the base pay plus the actual bonus. It is because not everyone got a bonus. Some people's their total cash is just coming from their base pay. And you can see that it's 190, 460, 585. So there's quite a bit of range here in terms of where companies are being paid for their total cash. So that number actually, Morgan just checked. That is correct. Thank you. The thing that is more stable, so obviously this can be a mix because this is, Morgan just practically had a heart attack over there, thinking, because we hate when there are data mistakes, but this is probably a very early stage company that has not raised a lot of cash, right? So they're not giving the CEO a lot of money. And I think actually that's really an important point to know because if you're doing that, let's say you're the CEO and you've given yourself very little money, or the median at 190 because you know that you're going to raise capital. It's important that you know that you maybe should be at 250 or $300,000 because it's going to come back later to cause issues for you. So you've got to make a note of it. What I think is so interesting here for these companies is that they've done a really nice job in terms of the equity, right? Here's the founder total. This is founder total equity it's almost the same median 75th and max. And so is the non-founder equity. And how that compares to a CEO, this is really great data that comes off of our platform. And then Carver, I'm going to let you get a word in edgewise to see what you're seeing here. So this is CEO median compensation by financing. So you can see the under 15 million of total amount of capital raised all the way up to 150 to 180 million. And you can see that the cash compensation in general rises the more money going in. This is the founder total equity, obviously got diluted. And then here is the non-founder. But look at that 5%. It's the same all the way across. So how stable are you seeing the market in Canada?
Yeah, that's interesting. I think that we would probably echo those figures for the different ranges of funding that you mentioned there, with
Yeah.
that 200,000 in equity and cash comp at the lower end, 5 million and under, definitely being somewhere that we see that being as well. All the way up to that $250 per hour.
Yeah.
That's where you're getting up into the five, 600,000 on a fully annualized 2,000 working hour a year. That's what that would equate to. So
Yeah.
um, we
Here's
see
the
those same ranges for sure.
Here's the 75th percentile. But what I think is really important about what you're saying is that apropos to the data that we saw from Canada, where the person was at $190,000, you have to be really careful with that because if you're doing that and you know you're going to bring in a fractional CFO or a CTO or some other job or a CHRO, there's got to be a relativity thinking about your comp philosophy to know that if you're this number one, how is the compensation going relative to you with the number two, the number three? Even if they're fractional, you've really got to think about the comp philosophy.
100%. Yeah, I'd echo that. We always get compared to the full-time market, and we do need to be in line with it. And so when it comes to fractional work, there's not a discount in the actual hourly rate or the compensation that the executive is getting. The discount comes by way of just using what it is that you actually need in terms of hours from that executive. So we definitely try to follow those ranges as well and make sure
Yeah.
that we're in line with them.
Right, because you may have someone. How often is there title inflation? I mean, we know this. This is the bane of our existence because what's unique about Thelander is we're not plugging into payroll because I feel like that is a very slippery slope. We have the survey, which of course I'm here pushing all day long because I can't tell you enough how important it is. And because also in that we do job leveling and we know that maybe if you have a VP or a chief title, that not all are created equal, that there may be title inflation, especially with a younger company And that has to be adjusted and corrected, or at least noted. So your VP may be somebody else's director, and that's got to be looked at on balance.
100%. That's easy to have happen at the lower
Yeah.
end of the funding scale. One of the ways that we get around that is we can call the roles head of,
Yeah.
rather than C-suite or VP or director. It's head of talent, head of finance, head of tech.
Yeah, here's some data I think is interesting to look at. So this is CFO, right? And this is total cash and non-founder equity by industry, and this is global data. So this includes the Canadian data as well. And it shows you by financing, the less than 50 million, the 50 to 130 million, and the 130 million plus. First of all, consistently the comp is going up. And I think that's, to be expected, right? The more money going in, the more money there is for cash compensation for salaries and if there is a bonus. But the equity is really staying very stable around 1%. And you can see there's a little bit of premium for a life sciences company versus tech. Does this sort of jive with what you see?
Yeah, I would say life sciences obviously being quite unique in the skill set and experience that they're looking for. Sometimes, when I work with a biotech company, we have a fair amount here in Edmonton, Alberta, from the University of Alberta. They're looking
Yeah.
for one of one, right? So when we're looking for one of one for a specific role, obviously, the comp's going to go up. There's going to be different equity components to it,
Yeah, let's
versus a
look
tech
at this.
company.
Here's like a C. We're showing you some data just 'cause I find it so interesting, and I think it's going to really help those of you. And again, feel free to ask questions or if there's something you want to see more of. So here's a CSO, and again, this is global data, and this is in the 50 to 90 million dollars of total financing. So this is the founder, obviously finally getting diluted. The comp is staying pretty consistent. And this is year over year data 21, 22, 23, 24, and 25. And it just shows you that the market really is speaking. So whatever you want to do, and here's the 75th percentile. So whatever you decide to do is what you have to figure out what makes sense with your company and also where that role is important. And here's a last slide to see, because we talked about some of the fractional jobs. So here's a life sciences versus tech for a VP of HR. And you can see that the life sciences tends to really pay a premium and even a noticeable difference on the equity side. I mean, life sciences now is sort of a broad catch, and obviously, someone like an HR person isn't necessarily have to be an MD or a PhD or someone who has the credential, but it is a more complicated world in terms of it's a long game. And even though the tech is staying, private longer as well, and it tends just to be a different type of the team that you're dealing with.
Yeah, 100%. I would echo that as well. And this goes back to my previous comment around life sciences and there being, very unique in the funding strategy, the revenue strategy being quite a long game and continuous raises, dilution, et cetera. And so that's where, specific CFOs we would want to bring into those positions, having had experience there. And I would say that speaks to the increase in salary ranges that we just seen on that last slide.
Yeah, any place where their academic environments tends to be like in Boston, and that's why we're doing a lot of work in the UK and in parts of obviously Canada and San Francisco. Here's some information on equity grants because that is obviously the reason why one of the added values of a private company, even though someone on the fractional side isn't getting that. So here are the different types of equity awards. The incentive stock options are the typical one, and we're seeing a little bit more use of restricted stock. These obviously have different tax implications that we're not going to get into, but we are seeing that the types of equity awards stay pretty consistent by the total financing. And you can see that in the beginning, companies use RSUs, and then it picks up a little bit later on. When you transition somebody from being fractional into being full time, how does that work with the equity?
Yeah, so sometimes there's an equity component, sometimes there's not. When it comes to fractional work, one of the big value adds for companies is that there's generally not an equity component, and they're keeping one of their most expensive resources in-house and then paying for the skills that they need. So when they're transitioning into full time, those are all negotiations that will help executives have with the company at the time of that. But before that, we've really gone through a really good try before you buy, we call it, model where the executive is working with the company on a contract or a trial basis, and the company vice versa with the executive, and we're all making sure that it is a good, solid, rock
Fit.
solid fit before they
Yeah.
go full time. And equity is then given. For example, bonuses are different, compensation's different, and there's just a lot more locking that executive into that. So we've seen it be quite successful, companies transitioning fractional resources into full
Yeah, it
time.
makes sense because in a role like that, you don't want to have turnover. And it's equally important for the company to see if it's a fit with the individual, but also for the individual to see if it's a fit because sometimes people like the flexibility of being fractional. And, if I were the fractional person, I would be negotiating equity all day long with everybody. That sort of sinks into the next area, which is important to think about for these companies, is about everyone always asks about a refresh program, about having what they call an evergreen program to grant additional equity. And you can see that most people are either no, they don't have a program, or they do, but it's not a formal program. And I think the part of this that's really important to understand is to figure out who is going to get equity in the beginning. Some companies have everybody getting equity in the beginning, but that is obviously not sustainable to give everybody equity over time because this sort of moves into the next part, which we'll talk about, which is the option pool, right? Because the option pool piece here is, let's see, pull this up. Oh, hang on, wrong picture. Screen sharing my children. Hang on. There we go. Sorry about that. Morgan, my daughter is again mortified that I just did that. So she's had 2 heart attacks on this call. Okay, so here's the option pool. It's good to just be a human being sometime, right? At least you know this
We're
is being.
Canadian, so we'll forgive you. We're very
That's good.
forgiving up
Thank
here.
you. Forgive me for the fact that I have my children
Yeah,
on my home screen. That means at least I love them, right? Okay, so
yeah.
here's the option pool information. And this is really important about the refresh. So the what we're going to focus on is this employee pool. And this is global data. So this is across all financing categories and the founders, the 25th, 50th, and 75th. It depends how many founders you have. But the employee pool you can see is between 10 to 15%. Board member is for outside board member comp. And then here are the investors. And then here's global data, same thing, 10 to 15%. So this is excluding the US. So what my point is for you to see that it's staying the same. And then here is the most important thing to take away. So here's a young company under 5 million in financing. And you can see that in general, it's still between 10 to 15% for the option pool. Obviously, the founders own more, investors own less. Now you're getting into an earlier stage company that's like moved past sort of the seed stage and friends and family. And I think it's really, I'd like to look at this more by revenue. I know it's going to be the same, but there's so few companies that have revenue on balance. But again, the employee pool in that 10 to 15%, 15 to 50, financing 10 to 15%, late stage 10 to 15%. So for all of you that are on, I think it's really important to think about your option pool needs to stay somewhere in the 10 to 15%. And it's really important to get the equity percentages right as soon as you can. And then this last slide shows you the other components, and we do this all day long in consulting about does that include these numbers reserve for the future option plan, which could be like if you're making or granted annually in new hire grants, which would cover for someone like a fractional person coming in. And obviously, depending on how many people are coming in, these numbers could be in addition to the option pool of the 10 to 15%, or it could be part of it. And then the refresh grants, which again depends on how good of a job that you've done. But it's obviously very important. Do you ever bring in outside investors or board members to these companies?
We haven't worked with any outside investors outside of venture capital groups that will help support their portfolio companies with
Yeah,
resources, but we haven't brought an investor to an actual company that is looking for investment. We somewhat stay out of that
yeah.
space. We're there to support with resources and solve problems when companies do have investment, but um, outside of that, we stay in our lane, so to speak.
Yeah. Well, why don't you give us, just as we're winding up here, a recap sort of what was the most prevalent thing you saw this past year and what you think is going to be what's heading for next year, since we're sort of at that inflection point.
Yeah, for sure. So it's been pretty big transition, I would say, over the last few years, and I'm sure that you've seen that from a data perspective as well. But up here in Canada, we're investing very heavily in tech, 2022, 2023, and that seems to have slowed down a little bit. Venture capital dollars are a little more risk averse. It seems these days companies are not scaling quite as aggressively. So this last year, I think we've seen a pretty big return to fundamentals actually, and that's why we're seeing CFOs being as popular as they are. I'm working on three fractional CFO projects right now, just in the last couple of weeks as we come to year end here. And then again, also to echo on the human resource front, that also being quite popular as companies scale their people functions along with their finance functions. So I think we're seeing a bit of a return to fundamentals for companies that need to show profitability and a solid revenue model. And obviously, if they're doing debt financing, they need to be outside the covenants with
Yeah.
banks. And that's where a fractional CFO also comes in. So, when we first started doing this 3 years ago, back in 2022, all we heard about was tech. Fractional CTOs. I need a CTO. I need a senior software developer. We need a UX UI designer. We need a data scientist because we're building out an AI model. Um, those things are still happening, but I definitely don't hear about them quite as often as we do with the more typical fundamental roles that you would typically see inside of an executive team for finance and human resources.
Yeah, it makes sense. Well, thank you for that. And my take on the same question about sort of what we've seen this last year, it's either been like we're super busy with the consulting and companies finally raised money. We are, I mean, I'm always bullish on the private markets because there's no question that innovation is not going anywhere. And as we discussed, we've seen public companies trying to take that more streamlined approach as well. And with the AI, there has been a lot of discussion around pay premiums for those roles. And it's just, I think it comes back to the single most important point for all of you private company founders and executives or VCs is that it's really important to plan, to pay attention to the teams. And with that, hand in hand, is the compensation and a comp philosophy and making sure that you're thinking very strategically about who you hire, how much you pay them, the mix between cash and equity. And given the fact that we're seeing, optimism for 2026, and we see it too. Funny enough, in this month of December, we are so busy, like with clients where we gave proposals months ago, people are feeling like, with things with tariffs and other areas that, okay, life is still going on, business is still continuing, deals are getting done, and maybe it hasn't been as easy, but all the more to your point that you've really got to focus on the basics at that, but it's still moving forward that you've really got a plan. It's never too soon to put your infrastructure in place, to think about your comp philosophy. Again, Morgan, if you want to put the survey link in here, I built J.Thelander on the give to get model because we're invested in the ecosystem and we want companies to be successful. And so giving you data and doing events like this, it's equally important for us to, be hearing from you all and understanding what your priorities so that we can partner with you, which is why we're here today. So we're at 1:28. I'm going to wind us up. Carver, thank you so much to all of you on the webinar today. We will send a follow-up and a recording of this. And should you have any questions, please feel free to reach out to us individually.
Yeah, thanks very much, Jody and Morgan, for having me on here today and the invitation. And we got a few of our fractional resources that joined, so hopefully they got something out of the data that you presented. That's something that we're probably missing a little bit more of in the fractional world. It's to use a pun intended, fractional in the sense that folks are everywhere and we're trying to get it all into one place. So this
Yeah, and if a
data is very
fractional
helpful.
person participates on behalf of their client, they will get access. Like we are not stingy about that. We want everyone. So, fractional or not, if they have a company email, we're glad to include them in all of this. So it's a
So
win-win.
appreciate that.
Great. All right, everybody. Thank you.